We're going to do a quick video here on target stock analysis for target stock, and we're looking at we're logged into rbamresearch.com and we're looking at the Target Corporation one-day bar chart. We have three moving averages on there. We have a 200-day, a 20-day, and a 5-day, and this chart is an excellent example of how to use moving averages to just kind of push past the nonsense and see exactly what's going on without really knowing anything about the fundamental analysis of the stock. If we go back here, we can see we started a massive bear market in this stock back in April of 2020, and we can define that as anything above a 200-day moving average. So this stock was consistently above the 200-day moving average with distance. Now this is not distance here, this is distance. This is distance, right? This is distance. So when you get a 200-day moving average and a stock is significantly above it and puts significant difference between it and the price and the 200-day moving average, you're in a serious bull market. And so you could see that just by following, you could actually build a computer program, an algorithm that measured this distance, and you could see exactly what was going on here. You could, there's a variety of ways you could do it. I can tell by looking at this chart it might be a little bit more advantageous to do it in several different ways, but the bottom line of it is we easily, without knowing anything about programming computers to look at stocks, we can easily see that this was in a bull market. Our 20-day was essentially useless because we kept getting these crossovers with the 5-day. Now the 5-day is the green, the 20-day moving average is the red, and the 200-day is the blue. We can see that if we had tried to do a 520, we'd have been whipsawed in and out of here all day long. It wouldn't have protected us really at all and would have given us a lot of false sells and so forth. But if you'd have kept your head about you and used a reasonable analysis of the gap between the 200-day and the price action, you probably could have caught a significant portion of this rally, which, as you can see, was way over $150. But here's where we started to have trouble, and it was fairly straightforward. We're working up to this massive drop here, but we'll get there in just a minute. You could see that pretty much your 20-day moving average was trending upwards, with the exception of right here, but even here this was almost flat and a gentle drop here and then right back on track. This would have given you serious pause, as well as this incredible gap between these two at this stage of the rally. So the gap between price and the 200-day moving average would have been really concerning because it was so huge. That expansion of gap, the amount of time that had passed, and the absolute price rally should have started setting off bells. But when this started at this point getting down this hard, this 20-day moving average getting this hard, and this price testing your 200-day moving average or getting close to testing it, that really should have set off bells. Now, you could have stayed in this stock and not really gotten burned too bad, just could have stayed in it, been whipsawed back and forth. Keep in mind, that's about a $40 move right there. But you could have done that. But when you saw this 200-day moving average go flat and you're down here, you're going to want to sell off into this rally. It's too late to sell here, and I'm not saying that as an absolute, but I'm saying if you waited, obviously you'd be down significantly, 80 bucks. But once you saw this go flat from a technical analysis perspective, you want to sell into any rallies here, and that's what you saw happening. You got a new high here versus here, but you definitely got a lower high here. So these closes, all of these closes below the 200-day moving average, that was your key that this move was over, and any rally you should sell into it. You can see that when this market rallied the first time, we got a close below the 200-day. It dropped down, it rallied into it, it tested it, and they sold the heck out of it and drove it all the way down. Same thing here. They got a little false buyout. Some people thought, oh, it's crossing back over the 200, it's safe to buy it, and you see they get crushed. Now let's move forward to closer to today. This stock price, you can see here now, the 200-day is flat. So now we're in a sideways market. But we have a deep, deep decline with the 20-day moving average. We have a huge gap between the 200 and the 20-day, and a huge gap here from price to 200-day. And that tells us the same kind of thing that it told us over here. This market is oversold and probably due for a good rally, and of course we got it. This huge gap here would have told you that you have serious problems continuing to stay short in this stock. And it also would have given you some encouragement that if you had bought it up in here, that you might be able to get out of it. And that's exactly what you see happen. The people who bought this rally late in the day all got out of it here if they were smart. And then we were set up for what followed. We had another close or significant closes below this 200-day moving average. You could have said this market was in a sideways motion here, but because it was never above the 200-day moving average, I would have said this market was a bear market right here. This was a setup to sell, not an opportunistic time to buy. Of course, if you're short-term trading, you could have done what you wanted to do. But if you were in this stock long-term, you would have seriously wanted to think about selling out of this stock on a test of the 200-day. We did get a violation, but you'll see it eventually your 20-day rolled over hard. Your 5-day really started to show a spread at this point, and that's when they sold the heck out of it. This kind of gap on a major stock like Target, that's a serious gap. Target's average trading volume is about 5 million shares a day. That's not huge. It's not that's compared to 75 or 80 million for the big guys, but that's still a significant gap we're talking about here. 207 to roughly what 170. Let's call it $35 gap in a single day. That's huge. And so whenever you have a gap like that, you have basically just destroyed mentally anybody who was still long that stock. And this is why you have this kind of uncertainty down here. This is just basically a kind of a washout move. People are exhausted. You can see we're still a significant difference between the price and the 20-day. So we're still in a serious bear market here. But the most important thing I want to point out is we haven't discussed anything about Target fundamentals. And that's really the most important thing of using moving averages and other types of quantitative analysis or technical analysis. You don't need to know anything about fundamentals. You can look at this chart and see that there was a very, very serious problem with Target when the 200-day went flat and the price was below it. No, it may not have been in a bear market, but it certainly was no longer in this huge bull market, this consistent bull market from March 20. That was over, and you could easily see that when the 200-day moving average went flat. So that's the beauty of using the moving averages. You don't need any fundamental analysis, and the problem with fundamental analysis is where do you get your information from? And sometimes you get your information from people who are trying to influence how you think and how you trade the stock. There's no way they can influence anything with this in a way that really can fool you, because you can just simply look at the 200-day moving average and say, hey, it's flat. We're no longer in a bull market. We may be going into a bear market, and that's exactly what's happened here. So how do you proceed here? Well, I'm not a big fan of it, despite I know quite a bit about it, but I'm not a big fan of moving averages at all. And the way I would proceed here is to look at analyzing this stock in a different way. So let's scroll down here and see what rbamresearch.com does. We do algorithmic price generations for 194 stocks every morning before 7 a.m. This is a list of those stocks, and you can see the tickers here. Our holding periods are 1, 5, and 20 days. So we use short-term trading algorithms to generate these prices, and they're basically for trading markets like this, these sideways type markets. When you have long predictable trends, and no trend is fully predictable, but when you have long trends like the ones we saw earlier from 2020, you don't really need short-term trading. You want to get in and hold it if that's your deal. But in my opinion, but if you want to trade it, or if you're forced to trade it, which is what's going on right here at the current, say, last 2 or 3 weeks, then you need something other than moving averages, because moving averages are just going to, a 5 and 20 moving average setup is just going to whipsaw you to death. So we've invented these to cover that. We have 194 stocks. Basically, you can 1, 5, or 20-day hold them. Let's take 20 days. If you wanted to 20-day hold Apple, and it hit your buy price today at 145.68, these change every day, Monday through Friday. If it hit your buy price at 145.68, then you could buy it at 145.68, assuming your own independent analysis said that was a good idea. These are just observation points, and they're not recommendations that you buy there. It's just for you to look at and decide what you want to do. But if you decided to buy at something similar to that 145, you would be expressing an interest to hold this worst case 20 days, 20 trading days, or take your profit as soon as you got it. So basically, if you bought at 145, you'd be looking for a rally, and if it rallies, you take it as fast as you get it. Take a profit as fast as you get it. If you don't get a profit by the 20-day trading day limit, the end of trading day on the 20 days, you close it out at a loss. And that's the same way with a 5-day hold, max 5-day hold, that close at a loss, or take your profit before if you get it. And the same day with the 1-day. Buy today, close out end of trading tomorrow. Worst case, with a loss, or take your profit sooner. Basically, by extending out further your on these holding periods, you're increasing your probabilities of having a profitable trade, and you're increasing your average win rate slightly. So that's how these work. We cover 194 stocks. We cover the major futures contracts. We cover the major currency contracts, and we also cover Bitcoin. Everything except for stocks, we have long and shorts, and stocks are longs only. Everything's published 7 a.m. Monday morning through Friday morning, 7 a.m. They're all free, absolutely no cost, no credit card required, and you can get them all at rbamresearch.com. You just register. There's a link in the description below. Again, the stocks, major forex pairs, and the major crypto, and the major futures contracts. If you like this video, please hit the like button. If you want to get some more of these, please subscribe. Everything that I've just shown you, everything on this website is for entertainment purposes only, including the entry prices. They're recommended prices to follow only, not necessarily to trade. It's up to you to trade with your own analysis only, and you definitely trade at your own risk. Please consult a financial advisor if you think you need one.